Hey everybody, I hope everyone's doing well. This video will be a recap of the Emini 5-minute chart for Thursday, January 2nd, 2025. Bottom left of my screen, we see the daily chart. Here's yesterday, this doji bear bar. And the first thing I like to consider is the stop order trade on both sides of the bar, so above and below the bar. What's the stop order situation? Does it make sense to buy above this bar with a stop? Does it make sense to sell below this bar with a stop? Is it a limit order market? And in this context, we have a trading range: big down, big up, big down, maybe a higher low here, but we have right now a high, lower high, a low. The bear's hoping for a lower low so that the market is in a bear channel, bear trend. But here, what about buying above this bar? Well, it's a trading range bar, and now it's a 4-bar bear micro channel. So the first reversal up is probably going to be minor. The signal bar is also weak. It's a bear bar. It's a trading range bar, probably sellers above the bar. As far as selling below the bar, also not a great sell because we're testing an area over here where stop order traders were trapped. Below this bar, we fell, but then reversed. And this is also going to be an area of support. So buying or selling here may be not ideal, but the momentum down is strong enough that a second leg down is likely because the first reversal is likely to be minor. So as far as selling here, there may be a little more to the downside. Maybe we test the low of December 20th, but also because we might be at the bottom of a trading range and the signal bar is a trading range bar, maybe not ideal to sell below this bar. So those are my thoughts going into the day. And then here's the 5-minute chart. We had a trading range in the second half of Tuesday, and I have Tuesday's low and Tuesday's high drawn in blue. And today we gapped up, and the gap up immediately was rejected. So bars 1 and 2, strong consecutive bear bars, both closing on their lows, both relatively big bars compared to these bars. So pretty good bear breakout, but the problem is that both bars are completely above the moving average. And so bear breakout, but straight into support. We're testing the gap, the close of yesterday. When I say yesterday, I mean Tuesday, the last trading day. But strong enough breakout that a second leg down is likely, and there's probably sellers somewhere above. You typically don't get bull trend days when the first 2 bars of the day are big, strong bear trend bars. So my thought after bars 1 and 2 was that a bull trend is unlikely. Therefore, today will probably be some sort of trading range day or bear trend day. But then we got the rally 3 through all the way up to bar 9 is a micro channel. So now we had big down, big up, big confusion. The market's in a trading range. I said there's probably sellers above bar 1, but we got the breakout, small follow through. So pretty good breakout, bars 3 through 5. But it's all within bars 1 and 2. And then when it really mattered, when it really counted, breaking out above bar 1, all of a sudden there was no momentum. And I think if you've almost all my videos, I kind of talk about this. When the market is far above the average price, traders are buying momentum. So the only way you can buy up here is if you're buying momentum, because you're not buying value. The fair price is down here. You're really buying value when you're buying below the moving average. So up here, your premise is that the market's in a trend and there's momentum to the upside and it's going to continue. So if you buy the close of 5, you start getting 6, doji, inside bar, trading range bar, another inside bar. Maybe 7's not an inside bar, but the point is lots of overlap, small bodies, big tails. These bars up here don't look like these bars down here. So I think a lot of traders who bought anywhere became disappointed by bar maybe 7 or 8. And when you have traders, you have bulls buying momentum this far above the moving average. If the momentum starts to slow down or disappear, we can get sucked back down to the fair price, the average price. In this case, I'm talking about the 20 bar moving average. So big down, big up, trying to break out of this bear breakout. The bull's hoping we get the measured move up. But again, all of a sudden, momentum disappears, and then a bear bar closing on its low, bar 10. So bar 10 is an always-in flipping bar. Bulls, long for any reason, probably exit below bar 10. Bears can sell. Taking a chance, we test down to the bottom of bar 3, the bottom of the bull breakout. Now at this point in the day, we break out to a new low. Actually, that didn't occur until 19, but the point is we had a high, a low, higher high, lower low. So the bulls hoping, I'll back up in a second, but the bulls are hoping on an expanding triangle with 2 pushes up, 2 pushes down, and then the market rallies to a new high. But bars 10 and 11, strong enough bear breakout, consecutive bear bars closing near their lows, crossing the moving average, second leg down likely. In this case, the first leg subdivided into a spike and channel trend. So bar 11 was a spike, 12 pulled back, and then we channeled down to 15. Ended up getting 2 or 3 legs down. So minor reversal likely, or pullback likely, correction likely, whatever you want to say. But the bar 12 high is the target where the two-sided trading began after the breakout. The channel phase began here. And that's what we got here. So 16, bull bar closing on its high, second reversal. We tried to reverse on 14, tried again on 16. So 16 might be an always in flipping bar, similar to 10. But a second leg down is still likely. And so if you don't get a good entry bar, if you buy above 16, 17 is disappointing for the bulls. Failed to break out of 12. Deeper pullback, better if there's no overlap. So traders might just give up on the trade. Bulls might sell out of longs that were taking a chance, and bears can sell again, or they wait for 18, sell below a bear bar, closing near its low. Again, second leg down likely. 1, pullback, maybe trend resumption. 2, but 19 might be a second leg trap in a trading range. 1, pullback, 2. Testing near Tuesday's low, lots of support. So we'll see what happens. Bad follow through, outside bar, and then we start to get an endless pullback. But the bulls, traders who bought up here, let me back up. 18 and 19 trapped traders. You had bulls buy the close of 17. You had bears exit above 16 or exit on 17. They missed the sell-off down to 19, so trapped traders above. Also, the market fell maybe 35 points in just 2 or 3 bars, and then it took, 8 or 9 bars to rally the same distance, so more strength to the downside. Compare the bear breakout to the bull breakout. Even though if you start from the pivot, the swing point, the 17 high, then you include 17, 18, 19, we have a bull bar and 2 bear bars. But again, we got there in a hurry compared to here. All bull closes, but not a micro channel. We have a pullback here, lots of overlap, inside bars, implied pullbacks, this is a channel on a smaller time frame, and this is a breakout. So what this might be is a spike and then a prolonged pullback and then a possible double top. We're testing an area where traders got trapped. So 28 is a bar where the bulls really need one more bar, at least one more bar, because it's not breaking out of the pivot point. We're not breaking above the bar 17 high, and they don't get it. So now 29 is a bear bar that bulls who bought for any reason probably exit below this bar. 29 is strong enough for a second leg down. And the risk is, if you're buying here, what's your trader's equation? You're betting this is a breakout on a higher time frame. Your stop goes below breakout. You're long here. Your target is Tuesday's high. But what's the probability we get up here before we get down here or before we pull back? The only way you can buy the close of 28, stop down here, and a target 1 times your risk away is if you're 60% certain or more than 60% certain. You need to have a positive trader's equation. So 1 times your risk, you need 60% probability at least. And even if you're that confident at this time, 29 is a problem, and traders probably exit below this bar. Even if it pulls back first, you have bulls who bought the close 28 disappointed. 29, they'll probably use any bounce to exit. So we're getting pullback and then starting to get trend resumption back to the downside. Also, from here, even though this is 2 legs down, this might all be just one breakout on a higher time frame. This, a deeper pullback, and then maybe we have to fall below 19. So this is the target for the bears. And again, think about it. If you're a bull, you're buying for any reason, doesn't matter where you're buying, you put your stop below 19. Does it really make sense to sell below 19? It might, and it might depend on the approach down, because this rally was weak and it is possible we get the measured move down. But because this is the bottom of a trading range, there might be more support down here, but it does depend on the momentum on the way down. 33, testing this area where bulls were trapped once again, but again the bulls need one more bar. And why is there a tail on 33? If it's a strong bull breakout, why are there sellers into the close of the bar and then a bear bar 34? So 34, certainly risky to stay long above or below 34. 34, now a third reversal attempt, bear bar closing near its low. The bulls had this rally. They're hoping for a second leg to at least get up here. And they tried once, they tried a second time, and they're failing. So when the market tries to do something 2 times and it fails, usually it tries to do the opposite. So once again, if you're a bull and you're buying below 34, stop down here. So you're on the close of 34. Are you 60% certain we're going here before here? If you're not, you cannot stay in the trade. You have to exit below 34. And bears will sell below 34. The risk is small. You could make twice your risk getting a test. So you sell the close. Twice your risk down to here. And it might be 50-50. So that's a positive trader's equation. Good entry bar for the bears and then good follow through. So think about the trader who bought down here, betting that this is the bottom of a trading range. 36 traps them. So the bull who bought here was obviously wrong. There was not support here, and the market broke straight through support. This becomes resistance. Tuesday's low, this breakout point, this is now a sell zone. Because of the bear breakout, there are trapped traders above. Traders who missed the sell-off are also trapped. They're looking for a pullback to sell. And bulls who bought are desperate to get out with a smaller loss. But we have 3. This is becoming sell to close. You have a bear bar closing near its low, bigger bear bar closing near its low, even bigger bear bar closing near its low. And look at the the tops of these bars, the highs have no tail. So it tells you right when 34 closed, traders sold the market. Right when 35 closed, they sold the market. This is a sense of urgency. Compare that to here. Traders can set limit orders at the low of the prior bar, and they're basically all getting filled. But here, if you set a limit order to sell at the high of the prior bar, you're not even close to getting filled. So here, the bull's not getting micro gaps. Here, strong micro gap, probably going lower, and might be sell to close 36. Is 36 a leg 3? 3, 19, 36? It might be. You always have to respect the opposite side. So if you're a bear, you see this bear breakout and you think, okay, 3 consecutive bear bars might be sell to close, but also might be 3 pushes down. We might be testing the channel line. So it is possible we have support here. But if you're going to buy, if you're flat and you're a bull looking to buy, you probably will not buy the close of 36. In this kind of scenario, it's better to wait for confirmation, and that can come in the form of a disappointment bar. So same with 19. Maybe 19 is a second leg trap, but consecutive bear bars, pretty big bar, 19. And you can argue there's acceleration on 19 to the bottom of the range. It is 2 legs down. It makes sense to buy the close of 19. However, other traders want that confirmation. They want to see the bears disappointed with bar 20, and they get it on bar 20. And so maybe you wait for bar 20 to buy the close and look for a test of the high. Over here, if you're looking to buy, maybe wait for 37 to disappoint the bears. And then, are the bears disappointed with 37? 37 is a smaller bar, but still no tail above, closing below the prior bar. So this is a lot different than bar 20. And we just continue lower. So there's really no reason to buy through here. And if there's no reason to buy, you can hold on to your short. 39, reversal bar, but probably sellers above. Bear breakout, first reversal, probably going to be minor. And then finally, we get a pullback on 41. Is 41 a good stop order buy? Probably not. The best the bulls can hope for at this point is a trading range. Now at this point, we're about halfway through the day, so what about day structure? What's today going to look like? We have a trading range open, and then is this going to be a bear trend that lasts all day? Probably not. This is unsustainable selling. Small pullback trends that last hours have smaller bars, and this is just accelerating really quickly, far from the average price with big bars. It's strong enough that you probably don't want to look to buy here, at least not yet. But as far as the rest of the day goes, it's possible we have an upper trading range, bear breakout, and then a lower trading range down here. And this may be beginning with bar 39 or 41. So still probably a minor reversal, sellers above. But now 4 or 5 bars sideways overlapping, so trading range, probably buyers below 41. In order to sell down here, it's the opposite of up here. If a bear is selling down here, they are selling momentum. Value bears sell up here when the market is expensive, far above the average price. We're way below average here, so you need above average price action like this. As we start to go sideways, more and more traders might give up on the momentum premise. And so if we get a bull bar closing near its high, those traders might exit above that bar. The bears might exit above that bar. Also, the trader's equation. Theoretical stop up here. You sell here. 1 times your risk is all the way down here. So you really need to be more certain than this, that we're going down here in order to hold short. You need sustained selling like this. If we start to go sideways, your momentum premise is getting weaker. then a bull bar closing near its high 44. Reasonable for traders to exit above it, but still tight trading range, probably sellers above and buyers below through here. And a very tight trading range. Getting a sideways pullback, bears hoping we have a bear breakout, pullback, and then continuation, but this tight trading range might be a final flag. You can call it a triangle. We're getting squeezed, bear breakout attempt on 49, but then bad follow through 50. So bear breakout, possible final flag, resumption attempt, failing, maybe the bulls have an attempt to go up. 51 bull bar closing on its high, reasonable for bears to exit above 51, therefore reasonable for bulls to buy. You run the risk if you're buying that we have a spike in channel and you're selling at the trend line. So some traders might wait for more information. 52 rejected off the trend line, but we're channeling 2 or 3 legs down, probably buyers at the new low. In a channel, bears sell rallies and take profits at new lows, like below 49 here. And that causes 54. Another bull bar closing on its high after 2 or 3 legs down. I think it's reasonable for traders to exit shorts above 54 so bulls can buy, taking a chance. Okay, entry bar 55. Better if it could get above the moving average, and better if there's no tail below, but strong enough breakout, second leg likely, buyers below likely, and then stalling at the moving average. I do have to speed it up just a little bit here, but bulls getting a second leg, but now maybe testing the top of a trading range. So getting the breakout attempt, failing, we have 2 legs up, so now we might be at the top of a trading range. The bears want a reversal attempt, but we have negative gaps from these. Let me draw it. Gap there, and at this moment, gap here as well. So the bulls have some open gaps, sign of strength, because in a trading range, gaps close. There's more overlap than this. This might be too tight for bears to look to sell until we go more sideways. But now we're getting the bull breakout. And now traders are wondering, where's the top of the range if it's not here? Could it be all the way up here? Maybe this breakout point, maybe Tuesday's low. 66, bear bar, closing on its low. But this is really the first decent bear bar since 52. We have a spike, pullback, channel, 3 pushes up, minor reversal likely, but now support here. So the bears really need more follow through. They don't get it on 67. It's really common to see those scenarios where one side needs one more bar and they just don't get it. 67, bull bar closing on its high. It's a 2-bar reversal. So any trader who was front running the bear breakout, they sold the close of 66, trapped on 67, probably forced to exit here. Bad follow through for the bull breakout, but also weak reversal attempt. So a second leg up likely. Now we're testing the low of Tuesday. Expected to be resistance. We broke below it. Traders may have bought here, hoping that it would be support. They got trapped. We're finally retesting it many bars later, so probably going to start to go sideways around here. And you can see really tight trading range, failing to break out above, but also I suspect breakouts below will also fail to go very far. And you can see we hovered right around this price, right up until the close. For stop order trades today, probably reasonable to sell below bar 1, maybe bar 2, but you have to be quick. You're selling right at support. You can buy above 3, buy the close 4 or 5, sell below 10, sell below 11, Buy above 16, sell below 18. Buy above 21, 22. Sell below 34. Sell to close 35, 36, 37, 38. Really tight trading range, not ideal for stop orders. I said you could buy above 51, didn't trigger. 54, also reasonable. Probably buy above 59, 67, and that's about it for limit order trades today. Let's see. What about buying below bar 9? We have a 7 bar micro channel. It's a bull bar, so why not buy here? Because it was big down, big up, and we're far above the moving average, it's possible we have to test back to the average price. So if you're buying here, you got to think, where's my stop? Is it down below 3? What's my probability? And if you do buy below 9, 10 is probably a signal to get out of the trade. Reasonable to sell above 13. It's a weak reversal attempt. You could also sell above 15, but at that point it's a second reversal attempt, and a deeper pullback is possible, like to the bar 12 high. So selling above bar 12 is reasonable. Spike in channel. It's a test of the channel on 17. Over here, low 1 short after a possible second leg trap on 19. You could buy below 20. Another weak sell, low 2, 22. You could buy below it. And then here, kind of the same problem as up here. If you're buying below bars, even though you have a lot of bull bars, you're at resistance, top of a trading range. So if you're buying here, it's really, where's your stop and what do you do? If you get a bear bar closing near its low, probably exit below that bar, and it didn't trigger until 34. Through here, you could sell above 40, 39. Over here, and then probably buyers below bars through here, tight trading range. It's a channel. You're going to have traders selling rallies and bears taking profits at new lows and bulls buying at new lows. And through here, we had spike in channel. We're testing. I don't know if we quite got there. But what some traders will do, 66, big bear bar, but not great context near support. Some traders will buy the close of 66, stop below 66, betting that the bulls are strong enough to prevent the stop order from triggering. So they'll buy, stop below, very small risk. So their reward relative to their risk more than makes up for the low probability. And then just really tight trading range at the end of the day. Sellers above bars, buyers below bars, right at that key price level, Tuesday's low. And today was a bear trading range day. Trading range on the open, bear breakout, and then more trading range at the end of the day. So what about tomorrow? Today was an outside bar. We tried to break out above the prior day's high, and this is the extended hours chart, the Globex chart. We tried to break out above, we tried to break out below. Both breakouts failed, but it broke out further to the downside. And now we have 5 consecutive bars without a bull body. So really not ideal for buying. If we do get above today's high, probably sellers above, but also if we get below the low, now we have a double bottom with overlap, tails below bars on this bear breakout. It's leg 2, probably buyers below. Inside bar, outside bar, probably more trading range price action tomorrow. As always, I appreciate everybody for watching. Please feel free to leave questions in the comments, and I'll get back to you as soon as I can. All right, thanks everybody for watching, and I hope you have a good night.